Hello and welcome to HSC Business Studies, Unit 3 Finance, and this is Lesson 4. And in this lesson we're going to look at the different financial institutions that operate in Australia. So a financial institution, they operate in financial markets. Now, financial market is similar to the market where goods and services are traded, except in a financial market, financial assets are bought and sold. So what is a financial asset? Well, a financial asset can be any kind of money-related object. It could be deposits, could be shares, and it could be debentures. And we looked at debentures earlier on in the lessons, which is a type of loan not secured by a mortgage, but backed by the assets of the company. Now, when businesses borrow money from financial institutions, there is a cost involved, and that cost is usually interest payments. Some of the institutions operating in financial markets are financial intermediaries, and these are institutions such as banks, finance companies, or insurance companies. Now, there are two types of markets in financial markets. A capital market. Now, a capital market invests in long-term funds, so it offers long-term funds to businesses. When we talk about capital, we're talking about funds that can be used for investment to help produce the goods and services that businesses offer. The other type of market is a money market, and that's a very short-term market for funds, usually an overnight lending market. Now, we're going to start looking at some of the financial institutions, and one of the first ones, an obvious one, are banks. When we talk about banks, there are four main banks in Australia: the ANZ, Westpac, Commonwealth Bank, and the NAB, the National Australia Bank. And they're probably one of the largest providers of funds to business in Australia. There are two types of banking offered, usually by the banks. The first type is retail banking, and we're all very familiar with retail banking. It's when we make deposits into our bank account. We have check accounts sometimes, and credit card services are offered by the bank. Now, usually, the banks will also offer retail banking. Now, retail banking as well offers banking to all the different members of the public. It also offers retail banking to businesses. Wholesale banking is slightly different. Wholesale banking deals with large transactions. It deals with domestic and overseas borrowing for business. So dealing with the larger end of the money market. Another financial institution is an investment bank. These can be banks such as JP Morgan Chase, Deutsche Bank, Macquarie Bank. Now, they provide services to businesses and corporate clients only. They don't deal with the general public. They offer a few different types of service. One is investment management, where they raise and lend funds for trusts or portfolios. So large businesses may have a portfolio of shares, lots of different shares which are managed by an investment management company. They offer financial advice on things such as takeovers of other businesses or the ability to raise capital. And they help in the money market. They deal with short-term borrowing or foreign exchange of money, usually for larger businesses. Another institution that operates is one that's familiar to most people: insurance companies. AMP, MLC, Zurich, even Macquarie Bank act as insurance companies, and they can raise very large amounts of funds through debentures, which we talked about earlier. They can offer money to businesses, and the business secures that loan with access to an asset as security. They provide medium-term financing to smaller businesses. And they're one of the largest competitors with the major banks. Another institution which many of you will be very familiar with, especially if you've begun to start work, being paid a regular wage, is a superannuation fund. Now, a superannuation fund holds large amounts of financial assets via compulsory superannuation. A superannuation is a payment made usually by the employer of, at the moment, 9%. There is a plan to raise that to 12%, and it's made on behalf of the employees by the employer into a superannuation fund, and that's held until retirement. Employees can also contribute to that fund. So as you can imagine, superannuation funds are holders of lots of money. They're also holders of many shares, because they buy and sell shares on behalf of their members. They try to make as much money for their members as possible. And they also buy property and finance property. So because they receive long-term funds, they can invest for businesses long-term. So they can give businesses large capital amounts. The final financial institution that we're going to look at today is the Australian Stock Exchange, sometimes called the ASX. Many of you will be quite au fait with selling of shares. All public listed companies can sell shares on the ASX. So they give companies access to a large variety of funds. If a business is a new startup business, they can receive funds through the ASX when people buy their shares. But the ASX must work under strict conditions. They must be equitable business transactions, which means that they must be fair. There are certain rules and regulations on how they can govern the stock exchange. But they give business access to lots of funds, and they also have that very important link between the businesses and the general public, so that the general public can invest their money in businesses through buying shares. We're going to look at the ASX in a little bit more detail later on in the unit. So that's the end of the unit for financial institutions. Hopefully you've made some notes and you have understood how they operate in Australia.